Hey, this is Corey Boldroff, the Real Estate Guy, bring you another monthly market update. We are in April of 2022, keeping you updated with real stats, facts, and quotes from the experts so you can feed through and weed through all the negative garbage you hear on, Facebook and social media and the news. We'll keep you up to date with real information so you can make the best educated decision for you and your family. So with no further ado, let's get into it. Again, it's Corey Boldroff, the Real Estate Guy. Like my videos, subscribe to my YouTube channel. Give me a big thumbs up. Let me know that you appreciate the information. As well, I wanted to let you know the new exciting news. We are now licensed in 9 different states. So Arizona, Nevada, Colorado, Texas, Oklahoma, Georgia, Tennessee, Florida, and as well as California. We can now be your one-stop shop for all your real estate needs in any of those states. I do have connections to all the other parts of the world, but me and my team can actually personally help you. Let's get back into it. So what we're going to cover in this monthly market update is the impact of rising mortgage rates, give you a little bit of an explanation of what's going on in the spring market, and as well as 5 key indicators that you can be aware of to watch what's going to happen in the market in the coming months ahead. First, obviously, mortgage rates are rising this year. At the beginning of the year, we were right around 3.25%, 3.8%, and already we're up to 4.67%. A lot of this has to do with the Fed's raising that 10-year bond rate, but as well as inflation has infected, so the Feds are trying to kind of combat that, and the mortgage banks are kind of looking at it and going, okay, we see where the writing is on the wall, we see rates rising, we better try to get a little ahead of it. So we've taken some big jumps up, actually the biggest jump that we've seen since 2018. Let me bring up this one little quick stat fact right here. So this in from Bloomberg, home buyers hit with US mortgage rates surging most since 1994. We've actually seen a 2% jump in the last 3 months, which is the biggest that we've seen since 1994. There was a slight one near 2009, but this is the biggest that we've seen. Also, what we're going to see is that rising mortgage rates are causing more home sellers to lower their asking price. So it might be the end of those huge over asking, bids, those multiple bids going $100,000 over asking, waiving the appraisal, waiving the loan. That might be the end of it. So as we can see, this is the highest that we've seen in rates since 2018. And actually in 2009, it was the only time that it was actually higher than we are today. So rates are rising, but I can tell you over a historical range, we're right in the middle. Usually rates are in between 5.5% and 7%. So we're just gearing towards or headed towards what the average mortgage rate is for a 30-year interest mortgage. So bring you a quote from the chief economist from Freddie Mac. Mortgage rates are likely to continue to move higher throughout the balance of 2022. Although the pace of rate increases is likely to moderate, much of the increase in rates in early 2022 is an anticipation of what will happen later this year, especially with the Federal Reserve interest rate policy. And that is basically they're trying to combat high inflation with rising interest rates to try to combat that. When we look at how impact of rising rates are on home prices, we're going to go back to 1993. So we saw a 2.3% interest rate increase in 1994 in that 3-month period. And we saw a appreciation of 3% in home prices. And as we move through 1996, 1998, 2003, 2005, and again in 2012, when we had at least a 1% increase in rates, we actually saw that home prices on average went up by 8%. So I usually say, as interest rates go up, prices start to mellow out. So we're probably not going to see that 22% increase in appreciation as we did last year, but we're not going to see a decrease or a crash as some of the market, news medias and social media and your friend that's the real estate expert that doesn't even have his license. It's just not true. It's not going to happen. There's not enough inventory, way too much equity, and there's not enough distressed homes to actually affect the market in a negative way. When we look at and continue on to home sales, now what we did see is a slowdown in home sales. Right now, buyer demand is through the roof. Some of it was COVID, a lot of it is the millennials and the people that are downsizing, those baby boomers. we've seen a lot of buyer demand, and to the point where as soon as the house comes on the market, it's gone. So we didn't actually have a inventory problem because there was actually more homes that sold last year than they have in the past 15 years in any one single year. It's been more about there's been so much buyer demand that people have been pulling off the market almost as soon as it hits, and low interest rates have helped that. So we do know, historically speaking, going back to 1994, as rates do increase, some buyers can't afford to buy the homes anymore. Some buyers are like, I don't want to get into the market at this point in time. So over the last 20 years plus, we've seen a slowdown in home sales of about 5% when interest rates rise at least 1%. And we take this graph one more up to where we see that in 1993, when the rates jumped up by 2.3%, we actually see a final rate of 9.2%. So when we're actually looking at the actual rates of when they rise, they were like 9.2, 8.23, 8.52, 6.29. So right now we're at 4.6. I think actually right now we're just above 5%. But you can see we're nowhere near where they were when they actually caused the market to slow. So right now, I still think it's a great time to buy because historically speaking, we're at a great interest rate, and you can always redo your mortgage and reevaluate that interest rate. So you can't buy last year. They always say the best time to buy was last year. It's because that's the best time to own ownership, is to start appreciating, start taking care of that tax incentives. So that is one of the reasons why last year was always the best year to buy. Although last year might have been one of the best times to buy because we went up by 22%. So, and we're going to go one more step further in this chart, and we're going to see months of inventory. Now, back in 1996 and 1998, we actually didn't have this information available because the MLS was pretty much just on a DOS format rather than actually being on the worldwide internet. So now that we can actually track it, we saw in 2003, 2004, when the rates jumped up, home prices went up, home sales prices kind of slowed down. The average home sat on the market about 5 months. As we came into the real estate crash, 2005, 2006, we saw home sale prices decreased by 14%. A lot of that had to do with interest rates went up, and they really affected. So that final rate, a lot of people were in those adjustable rate mortgages at 1% and 2% when they got in. A couple of years later, now they're 6%. The payment has tripled, and now they can't afford their homes. So there's a lot of distressed homes that went on during that period. And you can see it sat on the market for about 4.5, almost 6 months. It started to get a little bit, mellowing out in 2012, 2013. But you can see right now, we are actually less than 30 days on the market. So we're nowhere near what we were even in these examples going back to 1996. So we want to do a director of forecasting of NAR, National Association of Realtors, while higher short-term interest rates will push up rate mortgages. So we're going to look at the director of forecasting, the National Association of Realtors. While higher short-term interest rates will push up mortgage rates, I expect some of this impact to be mitigated eventually through lower inflation, which we'll see if that happens. Thus, I expect the 30-year fixed rate mortgage to continue to rise, although we aren't likely to see the big jumps that occurred over the past few weeks. Like again, over the last 3 months, we've seen them go up by almost 2%. That is a huge jump when it's considered the 30-year mortgage. Freddie Mac, history suggests that when rates rise, there is an initial bump in home prices as many move quickly to buy a home before rates increase further, which is what we're seeing right now. But after that period, home prices will slow. Freddie Mac analysts show that a 1% increase in mortgage rates results in a home price appreciation that is 4% lower than estimated. For instance, a 1% increase in mortgage rates will change a home price growth from 11% to 7%. So last year we saw a 22% increase in appreciation. The experts have called for about a 5 to 7% this year. So this might affect it and only see about a 1 to 3% appreciation growth this year. But prices are growing. Rates are going up, prices are going up. Your ability to purchase is going down. Again, I will specify or put out there that there are some economists and some housing data analysts that predict this might be the last year that the average American can buy a home. So whatever we can do to help you buy a home this year, I urge you, please do it, because if it continues the way that it looks like it's going, prices are going to keep going up, rates are going to keep going up, and your ability to buy is going to be gone. With rates rising and expected to rise through 2023, it makes sense to obtain a purchase or refinance mortgage if you are in good standing, which is basically what I just said. So what I do want to, before we get into the spring housing market, this goes to go along with the affordability that I was just talking about. So in Los Angeles County, the affordability over time. So we went back to 1980, where rates were about 13.75%. The average median income was about, sales price was about 108,000, and the median income was about 18,000. But your payment as a percentage of income was about 69%. Going to 1990, it went to 57%. And you can see throughout 2000 to 2022, we've gone anywhere from 36%, 27 being the lowest, and 66 being the highest. We just hit an edge near the highest. So we're now at 62%. So what it costs to get a mortgage and of your monthly payment as a percentage of income is about 62%. What I can tell you is there's a lot of people that have cash right now, either from the IDL money, the PP&E money, equity out of their homes, their parents passing away, their parents giving them equity. So that's why people have been able to afford. A lot of people have 20, 30, 40% down. But as you can see, the affordability has skyrocketed over this last couple months, or lack of affordability, I should say. So what we see happening is prices are going to increase, or rates are going to go up, prices are going to go up, your affordability is going to go way down. We do see a little bit of a slowdown in the Southern California demand year over year. You can see last year about this time, we had 19,308 in pending sales. Right now, we're about 16,000. Some of that is just due that we've had a lot less inventory than we did last year. So a lot less homes have come onto the market. So if there's no homes in the market, people can't buy. So I don't necessarily say that buyer demand. I think it's more that there's just no inventory and people can't buy it fast enough. What I will tell you, though, is that the writing is on the wall, that we've had just a slight increase in purchase applications, about 1.4%. But actually, we should be skyrocketing at this point in time in the market, because come May, June, July, that's usually when the most Americans move, because it's right in the end of the school year. People want to move after their kids get out of school. So the fact that we're starting to level off already does show a sign that maybe buyer demand is slowing down. Maybe some of the ones that aren't educated don't realize that interest rates are usually 7%, and right now they're getting afraid of like 5% because they've never seen that in the last 5 years. But I can tell you, it's still a great time to buy. So when we look at the spring housing market update, obviously no one has the crystal ball, but we're just going to look at some key indicators and kind of tell you what's going on. I do think that if you're thinking about selling in the next 2 to 3 years, I do believe this is one of the best times to be on the market. Low inventory, low competition, rates are still relatively low. So if we put your house on the market now, we're able to get you top dollar. I just put one on the market last week. We listed for $649. We had up to a $750,000 offer, $30,000 over the appraised value of the home. So I can tell you, there is still a great time to put your house on the market, but don't wait too long. We keep watching for it, but there are absolutely no signs of a market slowdown anywhere in the data. If anything were to come, if anything, we're seeing the market continue to heat up. That's Altos Research. Again, I like to give two sides of the equation so that we're not just spewing one person's perception of it, but we're actually looking at the data analyst. Well, I can tell you buyer traffic in February, going back to February where rates were, 1.5% lower than they are today. Of course, buyer demand was very, very strong. So this is a little bit outdated, but I do want to show you that everything is, has to do with timing and the indicators. And what I can tell you is that the buyer demand is strong in February. It's just going to get a little bit stronger throughout the months of, May, April, June, July. Seller traffic, what I can tell you is it's very, very weak, meaning that sellers aren't putting the houses on the market. It's People don't either A, are afraid of where would I go? 2, I want to retire in place. 3, I have a great rate. I don't want to sell to go get a higher rate. So all those things are coming into play. But what I can tell you is people are moving outside of the urban areas into the more rural areas and into those lower priced sales price homes. Arizona, it's strong right now because in the last 2 years, they've almost tripled in value. I know I was an escrow in a home in Arizona last March at 800,000. I just looked at the home today and it was $1,050,000. Didn't buy it. My mistake, just lost myself 250,000. Yeah, that's gonna hurt. Active listings increased for the first time in 6 months. So I can tell you is that we are seeing a slight uptick in listings, but we're still way below what they should be come March. March 21, which we had a really low inventory, houses on the market. We're 100,000 under what we were last time this year. So as we start seeing more houses come in the market, buyers will have more choices and hopefully, steady up the competition and as well as start leveling out those home prices for our buyers. Now more industry insiders are throwing out their previous forecasts and replacing them with more bullish short-term outlooks. Indeed, some experts say the 2022 spring housing market might go down as one of the most competitive on record. Again, as we see rates increase, buyers are starting to get a little bit more anxious and start saying, you know what, I better buy now, even if I overpay. I'm going to save hundreds of $1,000s over the course of my loan by having that lower interest rate, because we do know the Fed's meet in 2 more weeks and rates are going to go again up. How much they affect the mortgage rate, we're about to see. What we're starting to see over the last 5 Februaries is showings have surpassed what they were pre-pandemic numbers. So a lot more buyers are looking right now, even in February and up until now. And I can say we had a little bit of a slowdown. I felt in my own listings in February, but I can tell you this month has been unreal. When we look at the price appreciation accelerating percentage year over year price increases, we saw a 18 to 20% in some, this is national, but I can tell you in California, we saw a 22 to 30% appreciation rate. So it looks like 19% from year over year. So we are starting to see a little bit of a slowdown, but it's still appreciating like crazy. Last fall, we observed that home prices, although they continue to rise quite sharply, has begun to decelerate. Even the modest deceleration was on pause in January. The 19.2% year over year change for January was the 4th largest reading in 35 years of history. So all I can tell you, here are a couple key indicators. We got to watch the active listings. So as more homes come on the market, there'll be more competition. We'll see less overbidding, less 19 offers on one property. So right now is one of the best times to list. I can tell you that, speaking from my own experience, I have listings down in San Diego all the way up to Santa Barbara, and all of them right now are going through the roof. Single family housing units completed. We're at a 14 straight years below the 50-year average. A lot of it has to do with the supply chain, the cost of goods to build, and builders not being so sure of what's going to go on in the market. We're starting to climb up finally to get up to the annual, average annual units, but we're still not over what we need to be. And until we start really increasing the inventory of new homes, it's going to really allow existing homes to sell for even higher. What I can tell you is home price appreciation versus consumer price increases over the decades, that home ownership as a hedge against inflation is one of the best things that you can do. So I know we're all afraid of rising prices, but inflation, rising prices will only help the real estate. So you invest now, you'll be a lot better place off than investing into stocks or something of that nature. The potential gross and household wealth over the next 5 years based solely on the increasing home equity. If you purchase a $360,000 home in 2022, is about $96,000. So again, home ownership, investing in real estate, one of the best investments you can make, hedge against inflation, as well as build actual wealth for you and your family. So when we look at home price forecasts, this is the 7 big economists and data analysts and big banks. So CoreLogic, which owns Zillow, so obviously they're going to be much higher because they want things to sell, because they got into buying homes and they lost their ass this past year, because they can be a great home search site and probably not even the best home search site, but they suck at buying homes. So they see a 9.6% increase. We see Fannie Mae having a 7.6. We see Freddie Mac 6.2. Even Zellman, who's probably the most conservative, sees a 3% appreciation growth. So we're not going to go up by 22%, but we're definitely going to go up by 3 to 6% this year. So waiting to buy is not going to be the answer. Okay. Yes, you always want to buy low and sell high, but that's if you're planning to turn it over quickly. If you're planning to buy over a 40-year period, last year was always the best time to buy, because you'll have that much more equity growth over the 40-year period. So I hope you guys find this useful. Please let me know if you want me to do a market update in your neighborhood, or you want to know what your home was worth. And again, as always, if you find this information useful, please like, share, subscribe to my YouTube channel, as well as if you ever know someone who's looking to buy, sell, or invest into real estate anywhere in Southern California and now in those 9 different states, we can help you out. Always delivering 5-star service. Thank you guys very much.